Welcome to How to Win the Deal and Not Be Based on Price. The session is presented by Tucker Ellis and Citizens Capital Markets. Let's meet the panel. First, meet Jane Juven, Chair, M&A and Securities, Capital Markets Practice, Tucker Ellis. Next, meet James Irwin, Managing Director, Head of Buy-Side Practice, Citizens M&A Advisory. Welcome Eric Easton, CFO, Ampex Brands. Meet David Cheney, Founder and CEO, Coles Gray. And your moderator is David Dunstan, Managing Director and President, Citizens Capital Markets. David, take it away.
Well, hello everyone, and welcome to our panel. We're all excited to share our thoughts and experience with you today, specific to the buy side. All of you, I'm sure, are well aware it's a very robust M&A market, particularly if you've participated in any of the earlier panels. The market's red hot. There's a lot of capital chasing fewer deals, driving valuations to all-time highs. But that doesn't mean you can't be an effective buyer. And there are things, in fact, beyond price that are often very important to a seller. In fact, in many cases, we find the seller may choose the party with a competitive offer, but just better fit, better overall package. And we're going to talk more about that today. It's more applicable, of course, in a private company environment than a public company environment. And Jane will speak to that in a moment. But suffice to say, we have decades of M&A experience really within each person. So many, many years on the panel. So please take advantage of that and join us afterward as well for a live Q&A. With that, Jane, I'll kick it over to you and we can start the Q&A as well.
Okay, great. Thank you so much, Dave. I really appreciate it, and I'm delighted to be here with everyone. What we're going to look at today is how is it that you could distinguish yourself as a buyer when price might not be the only factor you want taken into consideration, especially in this red hot market that Dave mentioned, where multiples are going up, pricing is going through the roof, and you can only pay so much without getting over your skis. Everyone wants a successful acquisition, but when you overpay, it can be really hard to pull it off from a longer term perspective. Now, when we're looking at the pricing conversation, one item that I do want to note is that we're looking at it outside of the Revlon context in the state of Delaware. In Delaware, when parties are considering a transaction and a board is going to pursue a transaction, the duty shifts to maximizing price. It's particularly relevant in a public company context, but there are many instances in which today's discussion is very applicable. One is an alternative entity context where perhaps you have an LLC or another entity type where fiduciary duties are disclaimed. Another is in states that allow for consideration beyond price. Ohio actually is a state that has a stakeholder statute that says that boards of directors can consider more than just price and can consider the impact on stakeholders beyond just stockholder impact. And another instance is when you're able to get stockholder consent that allows you to go beyond price. With that being said, I'm going to lead a discussion with our first panelist, Eric Easton of Ampex Brands. And before we talk about distinguishing ourselves as buyers, Eric, if you could give some background on your position in Ampex Brands and your corporate growth strategy, that would be great.
Yeah, great. My name is Eric Easton, as she mentioned. I'm CFO of Ampex Brands Family Companies and Affiliates. And we are the owner and operator of approximately 400 restaurants, which is going to be more in about 1 week from now. And by the time you watch this video, it'll actually be more by that time. And then we also invest heavily alongside private equity firms in non-competitive industries where we currently operate, as well as in the real estate portfolio where we operate quite heavily as well. So our growth strategy for Ampex Brands is generally three avenues. One is to continue to operate what we call our cash flow businesses and what we're a specialist at. So we're restaurant operators at the heart, both franchisee and franchisor operators. And that's where we make our operating cash flow and what becomes what I like to call the ATM that funds all their growth in our business. Our second avenue of growth is usually within the real estate portfolio, where we tend to buy real estate under our operating assets, as well as buying real estate that fits within a portfolio of what we understand. QSR restaurants, fast casual restaurants, C-stores, as well as some office buildings where it seems to make sense, and shopping centers where it makes sense and there's good value for us. The last is we continue to look at alternative investments where we're not an expertise. We can find a private equity firm specifically that is, where we can make minority investments or make investments that are minority positions in companies that we don't operate but fit within our portfolio of the restaurant companies. A good example of that is in the last 12 months, we've invested in an insurance and warranty company. It's neither in my expertise wheelhouse nor anybody else's in our operating team, but we're partnering with a private equity group that has particular speciality inside insurance and warranty companies, and they've had a streak of doing well in the last 5 to 10 years. So our general growth is to do that across those three avenues and form more relationships across the different industries where we can find places to invest.
Eric and I are deep in the trenches on a transaction and have worked side by side for quite some time now. And, we are in the middle of this hot market where there's so many buyers chasing too few deals. And, one of the key parts of winning, particularly in an auction contest, is distinguishing yourself. And as we've worked side by side, one thing that I've repeatedly heard Eric say just over and over is, I have a relationship with this person. I might be able to get more insight because of my relationship, or, I have a relationship. And so they might look at us as though we have more credibility. We bring, there's trust already at the table. It's not like we're starting new. And Eric's somebody who truly works to build relationships over the course of his career and then brings them to bear when there is a deal on the table. Eric, could you talk with us a little bit about how you've gone about successfully building those relationships over your career, and then how you've leveraged them even recently in your current transactions?
Yeah, so there's lots of ways over the last several years I've been able to build relationships. So starting as a young analyst in a company that ended up going public, I had the opportunity to work directly with the CFO and the corporate development team and be a piece of the puzzle, because I was the guy that Brett ran the team that provided all the financials, that did all the deals and reviewed all the financials. The restaurant space that I primarily operate in is a very, very, very small space. While it is one of the biggest industries in the world, it still has a very small level of players that operate in that space, and they tend to pollinate other companies. For example, the same investment bank I worked with on a distressed deal less than 2 years ago is the same investment bank I'm working on with now on the deal that Janie and myself are working on as we speak. So what I found is that if you build a relationship with the people that are part of that bank, and they trust you and they believe in what you're going to say, and they know you're the kind of person they want to bring deals to, it happens over and over and over again. So if you have an investment bank, for example, the one I'm working with right now, they're also trying to pitch deals to us. We're talking about upcoming deals when we haven't even finished this one. And the reason is because they like the way that we work with them. We're good people at heart. We believe in people, and we believe at the end of the day that we build our business based on relationships, not just on finding the right value in an organization. Because at the end of the day, what you do with an acquisition after you purchase it is all on your head, not on anybody else's. You don't have to say yes to everything. Is something that we've always talked about here at Ampex, is that if a deal doesn't work for us, don't continue to press at something. And I think that's what the bankers and across the spectrum have liked about working with myself, as well as our CEO and the executive team that we have in place here.
Eric, how do you think that translates when you have a management team that will be coming over to you and becoming part of Ampex Brands? I'm working on a deal right now where the due diligence process has been tedious. The management team of the target company is just fatigued, and no one's excited about moving over just because the way the process has been run. Given the level of trust that you've built with these relationships, do you think it's easier to get the incoming management team on board who you're going to rely upon as you're getting this business off the ground, at least for a period of time under consulting arrangements, or in some instances, longer term employment contracts?
I think that the answer is yes, but I think that when I think about things, I bucket them into three big buckets when we look at the space. One is the proprietor, right? The person that is a single owner of the business. It's been their baby. They developed it. They've grown it. The second is a private equity transaction with a management team that is looking to sell the business. And I think the third is whether it be a public or another private transaction that is a person that is more financial in nature of what they're doing. I think at the end of the day, we reach out, and our position is never to assume that the management team has done something wrong. I think our position is always to assume the best, even if we're asking questions in the background, in our boardroom or inside the offices that we work in. We never let the target understand that we're having questions about their behavior and what they're doing. So that way we're building relationships built on trust. And then what we do is we have honest and candid conversations with people across the table. We make a decision very early with people to determine whether we're going to need them as part of the ongoing management team or not. And we address that very early with them. And I think that if you're just honest and upfront with most people, right, and you're direct with them, they take that. They'd rather hear a no today than be strung along for months through a transaction process. And then you tell them on the last day, I don't really need you, or I don't want you, or I really need you and I haven't treated you well along the way. If you start at the beginning with the best sense in mind and tell everybody that you're just going to be honest with them, the results will usually end up being good.
And Eric, before we turn the conversation over to Dave Dunstan for a conversation with Dave Cheney, any final remarks about the importance of building relationships? Anything we haven't covered yet?
I will tell you that myself or my CEO, Tabasum Mumtaz, we have done everything built on relationships. And that, frankly, is what I learned early in my career. I sat down early in my career with the CFO. His name is Jeff Rager. He was a mentor of mine, continues to be a mentor of mine. And it was amazing to me back in my 20s how he was a person that could just say, to reach out to somebody every quarter and say, hey, how are you doing? And I think that skill that I learned from him, and that skill that sort of comes to some extent naturally to me to want to build relationships, has carried us and brought us deals and brought us benefits that we wouldn't normally have. We have banks that want to do things for us, both commercial and investment banks, that are willing to partner with us with little information and very quickly because of the relationships we've built and the trust we've built there. And I think that is invaluable. And a lot of times people they underestimate the value that brings to any deal.
So David Cheney, you've had a long, successful career making acquisitions in the industrial space, which I think will complement nicely the restaurant conversation we just had. I'd love to hear a little bit more about your background, share some of that with the audience here tonight. And then also, if you could, expand on that dynamic of how you differentiate yourself as a buyer beyond price. What are the attributes that you have used to be so successful in your acquisitions, again, beyond the price perspective? Love to get your feedback on that.
Great. Well, first off, my background is that I'm a CEO of Coles Gray, a private equity group focused on investing in industrial companies. Prior to that, was the CEO of Stelco Holdings, Inc., largest publicly traded steel company in Canada. I absolutely agree with the statements regarding relationship. And I think ultimately great relationships move into a trusted reputation. So I could not agree more with Eric's points. And I really think that his comments around building relationship with bankers and lawyers and a successful transaction, and a successful transaction doesn't necessarily mean you won. A successful transaction means that you participated in the process, you got to know a management team, you delivered what you said you were going to deliver. That creates a sense of trust and a sense of a great reputation in the industry. And so that goes part and parcel with relationship. When I think about how to differentiate, it really comes down to alignment. And it comes down to, for us, is where are there situations where we can be an impactful bidder because we're aligning with the core visions and values of the seller. So if you're talking about a situation where it's a family-owned business or a financially owned business that has unions, has workforce, it really comes down to, do you use your ears and listen to what the people that are running the business, that are doing the work, are telling you? What are the growth opportunities? What are the challenges in the industry? What can be done today to improve the business? How can you grow the business? So it really is about listening and making sure that there is alignment. So first and foremost, it's all about that alignment. And look, not all situations create that opportunity. There are just some situations, whether it's public, whether it's private, whether it's family owned, the only thing that matters is value. So I think when you're looking at any situation, the first question is, why do I want to own the business? Why should I own the business? And why are we good owners for the business? If you can't answer those questions to a very satisfactory level when you start, you probably shouldn't be in the game, unless you're just going to go blind and bid the highest price. So what we look for are situations where we think we have a competitive edge. In our case, it's all about heavy industrial manufacturing. What can we do to make a more efficient manufacturing business in North America? Whether that's around labor relations, whether that's around automation, around data and data-driven decision making. So that's our core competency. And the next question is, what we want to do in any business is inject capital beyond the acquisition. We want to grow. We want to build businesses. So if we want to deploy capital in multiple tranches over time, what that really means is that our seller needs to have a vision around how they want to deploy capital. And look, there are some private businesses that are very, very conservative, that really don't have great visions of how to deploy capital. That's a great situation where we're not going to have alignment. So it's all about seeking that alignment, understanding what we do well, which is we back great management teams who have a vision on how to grow their business in very turbulent times. That's what we do. And the way that we differentiate beyond price is we listen to what the management team has to say, what the workers have to say, and we try to align what their view of the future is with our view of the future. And if that meets, then that's gold, right? That is a phenomenal foundation to then do your work and do your diligence and continue to now, back to Eric's point, build that relationship with the team, with the workers. It's all about building that momentum, but you can't build it if there's no alignment. So why don't I pause there, Dave, and let you redirect, but that is absolutely the core principle of what we focus on.
Yeah, that's helpful. And the lessons around relationship building and really active listening, so you can make a decision as to whether you line up well. That alignment concept, obviously, really important when you're trying to position yourself as a favored buyer. So definitely appreciate that insight. I know that's been part of your success. And I think what's interesting as well is both parties talked about, very specific industry knowledge, expertise, and relationships within their sector. And it speaks to that sector knowledge and expertise that's also so valuable in this environment around distinguishing yourself. You're not trying to boil the ocean. You're really targeting restaurants in one case, certain industrial businesses in another. You might want to, either of you gentlemen, speak for a moment about the value of being disciplined around, in this environment, you get a lot of calls, you see a lot of stuff, but the value of being disciplined with regard to your approach and how that leads to success. I don't know, Eric, if you might want to start, and then David, share your thoughts, that would be great.
Yeah, one of the things about casting a wide net is you get a lot of things thrown your way, and not everything is a good fit. The way our organizational structure is set up is we operate a shared services platform that supports a number of different organizations that we own. And so when we look at things both strategically for a fit for our business, as well as things that create general administrative leverage for our business as well. Things that we can bolt on quickly and operate without much fuss and get things done. So when we look at things that we know that we can get either buy to sell or buy to hold. So those things that we know that are good value businesses that drive free cash flow, because we're a private business, we're not private equity with a fund behind us that has to have some sort of liquidity event. We make decisions that are going to be buy and hold for free cash flow, or buy to sell, which may be like a business that we're looking at that's not the current deal we're looking at now, but another deal we're looking at, which is we know the business is in somewhat of distress. We know that we can stabilize the business, potentially restructure the business, and take it out and go and sell it again. And those are the kind of things that we're diligent about. They have to be the right value for us, and our approach has to be in the same way every time. Otherwise, we're going to miss something and go sideways on one of our deals.
David, any other thoughts?
Yeah, look, I think discipline is absolutely critical, particularly in today's environment. And we talked about now relationship and reputation. The next piece of this is, if you're going to invest resources to run at a business hard, the question is, are you going to get to the finish line? And now that gets back to reputation and that discipline. I think that it's really important in today's environment to get to that, as Eric said, that quick no. And, you know what, this isn't for us, guys. We're sorry, but we're going to move on. So that people know that when you're really digging in, you're for real. So you can't have that reputation of being serious if you look at everything. So you've got to stick to your knitting. You need to know what you're really, really good at, what you want to focus on to own. And if it doesn't hit those criteria, do not deviate. Stick to what you're good at. Keep that discipline filter really small, and it will really help, particularly as you have a lot of other buyers out there who may not have that, again, that reputation, that relationship, and that discipline.
Very good. I think, Jane, you want to pivot over to Jim and get some more feedback.
That would be great, Dave. So Jim, as I was preparing for today's panel, I had to tell you I was so impressed with your background and your biography, and the fact that you've been in the corporate development roles and now also the leader of a buy-side practice at a prominent investment bank. It's truly impressive. And if you could maybe talk a bit about your background and the tour that you've done, and then also to pivot to a discussion of best practices that you've seen along the way in terms of distinguishing yourself as a buyer and having it not be all around price. And then we can work together as a group to unpack that a little bit.
Very good. Thank you. So I've had a unique career. I'm currently managing director and lead the buy-side practice for Citizens Capital Markets. And really in that position, spend 100% of my time helping companies that want to play offense and go out and acquire and grow through inorganic means to do just that. Help them to identify the right targets, approach those targets in the right way, and ultimately diligence and close on them. I've been here for 2 years. Prior to that, though, I started my career and spent 15 years in investment banking as an M&A banker. And then I moved into the corporate world, as you alluded to, where I spent 3 different tours of duty, so to speak, leading corporate development and corporate strategy functions for 3 different multinational, multi-billion-dollar publicly traded organizations, one of which happened to be private equity back prior to our taking it public. So I've seen M&A and organic, or I should say inorganic fueled growth from very different chairs, both as an advisor and then also sitting in the chair, being responsible for the deals and the integration on the back end. You mentioned, some of those best practices, and I think I draw a little bit of from my past in the corporate world in kind of sharing some of those best practices that we used along the way in those stops. And the first, I think, is very similar to some of the themes that other panels have been touching on so far, and that's really focusing on each seller's hot buttons. As you get to know somebody, as you start early in building that relationship with the seller, you hear things, you learn things that are important to them, whether it be how the transaction will be conducted, whether it means the ongoing operations of the company post-transaction, whether it means tangible or intangible elements for certain others on the periphery of the transaction. You learn things. I'll give you an example. In the corporate world, at one point, I was in the mining industry, and we acquired a series of mining assets. And one of the things we heard throughout in dealing with the principal on the other side was, what's going to happen to my employees' soft issues they're going to want to have addressed, like their healthcare benefits, like the annual picnic, like their boot allowance to buy up their work boots every year. I need to know that those things are going to remain intact. They seemed a little bit odd. They seemed a little bit non-important to the overall structure of a nearly $1 billion transaction. But what he was really saying is, I live in a small town. I've got to see these people after the deal, and I've got to make sure that they still feel good when I run into them at the grocery store. And so as we went around and did the integration, we only closed on that transaction, as we rolled out the deal to each of the operating entities at mine level, every shift, and we talked about who we were as an acquirer, we got 3 very simple questions each time out of maybe 4 or 5 in total. And it was exactly those 3 issues that the seller was so worried about making sure that we had addressed up front for him. So listen to the hot buttons for a seller, make sure you understand what they are. Second, I would say, is how do you make a seller feel special? They're getting a lot of inquiries today. Any seller will tell you that they're getting multiple inbound calls about, will you sell? If they're in an auction process, they're getting 60 or 70 written offers if 100 books go out. So they're seeing a lot of interest, but how do you pick and choose then beyond the price? And I go back to, how do you make them feel special? A lot of times that may be, do you involve the rest of your C-suite in the discussions with the seller? Can you find a reason for the CEO to be in that area and join you for dinner with a target when you're trying to cultivate that relationship? Maybe it's taking a seller that's worried about how they're going to report and where they're going to report. And maybe instead of reporting to the COO on day one, maybe they report to the CEO as a standalone division that could be grown up over time. Again, helping them to feel important in a transaction. Thirdly, I would say, how do you involve your past successes? The more you can get folks that you've entered into negotiations with, closed on transactions with, to be your cheerleader to the next target is always to your advantage. They can talk about the positive momentum that was created through the transaction, that hopefully you as a buyer delivered on what you said to them. And hopefully that goodwill and halo of optimism starts to set in for the next target that you're trying to acquire, and they continue to feel good about moving on in the discussions with you. And lastly, I would just say, keep your organizational reputation intact. In many industries, I can speak from the corporate side, they're very insular industries. People know each other, as in most. They talk about who delivers on the commitments and who doesn't. And so the ability to keep that organizational reputation intact, doing what you say, continue to deliver every time, on time, with what you promised, not over promising, but sometimes under promising and over delivering, helps to keep that reputation pristine and seen in the industry the way you want it to be seen. So a few topics, I guess, that go a little far and wide in how we've applied them in the corporate world, but some things that I've seen that have worked for me in the past.
Jim, I thought that was really good advice. And the first item that you mentioned about this, listening to the seller's hot buttons, definitely resonated with me. I remember a situation from a couple of years ago where we were serving as counsel. We were actually on the sell side. It was a competitive process, and there were 2 bidders who were finalists, and they had very different strategies. One came in and just said, we're going to pay whatever we need to pay in order to get this deal done. rest assured, if somebody else outbids us, we're going to top our offer because we really want this business. So we should be the winning bidder. The other one was more at the periphery, far less direct. And honestly, at different junctures, we wondered what they were doing. But come to find out, what they were doing in terms of the process was really listening to the seller and what mattered most to them. And it was a situation where this business was essentially in a company town. They were the main employer. It was closely held, a lot of family members running it. Legacy mattered to them. They took seriously the fact that they had such an important impact on the lives of the people in their community. And their number one consideration wasn't price. And it actually had never even necessarily been economics, because they had always paid their employees above market, even though they didn't have to. Their number one consideration was, is this buyer going to retain a substantial number of employees post-closing and even grow this business so that there are more jobs in this community, not in other communities? And they made the pitch, and we had extensive conversations with the seller about what their fiduciary duties were. Could they only consider price, or could they consider the interests of other stakeholders? Fortunately, we were in a jurisdiction where they could consider the interests of other stakeholders, not just maximizing price. And I'm sure you can all imagine who it was that won in that process. But it did, to your point, show the importance of listening and understanding the seller and what they're truly trying to accomplish as part of the process.
Yeah, and that makes me think of one of my favorite sayings, which is be long-term greedy. And when you're getting to know somebody before the sale is taking place, you've invested the time to get to know them over the years, and you play the long game, you have a better chance of being able to then get to the soft issues and address the important non-evident issues than once the lights come on and it's time to enter into the negotiation. So I always think of how can you be long-term greedy in building those relationships with targets over time. It doesn't have to be that the deal is going to happen that day or next week or next year. It may be years in the future, but be long-term greedy, you'll learn a lot along the way.
One thing you mentioned, Jane, was integration. And I'm curious with Eric and David, when you generally introduce the integration concept and process, and how that can be to your benefit in terms of distinguishing yourself.
I think it depends on the deal, right? So let's just talk about what we're doing right now. This is an example of where there were hot buttons with regard to the sellers and making sure that the business is going into the right hands and doing the right things. So we immediately talked about integration with them and how we were going to handle it. We didn't make any commitments or any promises because to some points that have been made already, you don't want to overcommit and underdeliver. What we said was that we want the business to grow again. We don't know how long it's going to take for us to get there. We also want to do our best to accommodate a good transition of the people that are operating the business today into our new business. We need some time to do an assessment of all the people and then make offers to those for a transition. And so that worked very well with us. Our method is always to be direct, upfront, and straightforward and tell them exactly what's coming down the pike. We set a date. In the future when we were going to go ahead and let them know who we were going to hire, and we committed the date and we hit it. And those people that we weren't bringing onto the team, we told them directly face to face that it wasn't going to happen. Now, again, this was a smaller transaction. You can't do that in every one, but you can at least do that with the leadership team and the middle management. The other thing that we did was we sent memos to them telling them exactly the list of things that we were going to do, that we're going to transition the business to the new one, and where the roles and responsibilities were going to lie, and got that alignment from them up front. And that's how we've done it with this transaction and how we tend to operate the vast majority of them. There are things that can't go that way, especially in distressed worlds, right? If you're buying a distressed company, it's a little bit different than when you're buying an operating company that is doing the same things it should be doing every day.
Yeah, look, I would say that they're very similar, frankly. Our keys to success around integration are about transparency and alignment. right? Understand what your target envisions in terms of the end goal. What do you envision as the end goal? And collectively, how do you craft the integration plan to achieve that? If you go back to my opening statements around building businesses, it's a non sequitur to say we want to build a business, but we're doing it our way. Those two things don't go part and parcel. So we start with alignment around where do we want to end, and then how do we craft the integration and execution plan that maximizes what we bring to the table and what the management team and the rest of the team bring to the table. And reality is, I think successful integrations are virtually bespoke for every situation.
Yeah, it makes a lot of sense. I know we've got maybe 3 or 4 minutes, and I'm wondering, I bet each person has sort of their recommendation for the audience as sort of their number one sort of best practice. We've hit most of them, I think: relationship, trust, alignment, discipline, make them feel special, things of that nature that you can integrate. But just curious if there's any other words of wisdom on the panel here they'd like to share with the audience as we get closer to wrapping things up.
I'd like to just simply say that the best way to differentiate is less talking, more listening. You're going to get a real sense of what matters to the seller if you take that approach. So that's the word of wisdom.
Good advice. Any other comments?
I would say,
Sorry, go ahead, Jane.
go ahead, Eric.
I was going to say exactly. I concur with what you're saying with that. I would also say, don't let yours or your team's ego get in the way of a good transaction.
Completely agree. And I was going to say sincerity and authenticity resonates. And I think being willing to listen to the other side is key, and the beauty about deals is that oftentimes they can be win-win. So painting that picture, I think, is really important in the process.
And I guess lastly, I would add as well from my side, the more you're talking around how you're partnering with somebody, how you're entering a new business arrangement together with somebody, as opposed to acquiring somebody or buying somebody, has a lot of impact on how that target feels as they're forming that relationship with you, coming into the deal with you, and then ultimately operating with you after the fact. And you only get that one time to make that impression, make it one of partnership.
That's powerful. It's interesting, a bunch of M&A discussion. It wasn't a lot of finance and accounting. It was a lot of emotional intelligence and listening and relationship building. And obviously finance and accounting are the building blocks of all of these things when you put it all together in a spreadsheet. But if you want to win in an auction environment that's highly competitive and be selected as the best buyer, it takes a lot more than often just paying the highest price. You want that party on the other side to want to partner with you, to your point, Jim, the relationship point that everyone has made, making them feel special, finding the alignment. And when you find that alignment, close fast, work well with your colleagues, Jane and her team, having professionals that know how to navigate the rest of the documentation and get it done can really make a difference when that seller's starting to have the toll that it takes on them to get to these points. So I think this was really, for me, I always learn something on these panels, and definitely enjoyed the conversation. Jane, any last words?
I just would thank you all so much for your participation. I'm looking forward to the Q&A and seeing everybody on the other side. But I think the advice given today was worth its weight in gold. So thank you for everybody for participating.